Hello, our guest today is Akshaya Bhargava, who is the founder of Bridgeweave, the company behind InvestorAi, a smart tool that helps retail investors make informed decisions about their assets. We had the pleasure of speaking to Akshaya last year about the merits and the vision behind his product. Today, we've met up again to hear an update on the key developments and his general views on the fintech landscape. Hello, Akshaya.
Hello, Margosha. Great to see you and talk to you again.
We're super happy to. So let me start with the first question. Thanks to your vast experience in wealth management, you have a deep understanding of the financial sector and how it's evolving. From your personal perspective, what recent changes in the financial industry do you consider the most impactful, and how do they influence the development of the Bridgeweave's suite of products?
That's a great question. See, I think something wonderful is happening in the wealth management world. The old model of wealth management is that I do things for you for which you pay me. So I give you advice, I manage your portfolio, and I basically do things that for which I get paid. The new generation, what I call the digital generation, not necessarily millennials, but anybody who is digital friendly. The digital generation is not like that. They don't want to deal with banks. They don't want to deal with wealth managers. They don't want to pay for advice. They want everything on their mobile phone. And if they want everything on a mobile phone, then there is no place for an advisor to come in and do anything. So, and I think this behavior is going to change the model. And I think the model will be driven by the new generation who wants, low-cost services. They want access to everything and not, selective kind of things. They want everything digitally, and they want transparency and ethical behavior. Now, I'm not saying wealth management cannot deliver that, but it is very difficult for them to do it digitally. And I think what is developing and will become big now is a new model for wealth management, which won't be wealth management, which I'm calling wealth enablement, where instead of paying me for things I do for you, pay me for tools and services that I give you that allow you to do what you want. Self-service is a big part of it. The mobile, things delivered on your mobile phone is a big part of it. Low cost is a big part of it. Transparency is a big part of it. Easy access is a big part of it. The right asset classes, which in my view are equities and crypto. They are not funds, they're not ETFs, they're not bonds, they're not commodities. It's ETF and crypto mainly. That is a part of it. So there is a whole new model that is emerging in the world. And last thing I will say is that if I was a wealth manager today, I would really be worried about it. And I would be doing whatever I can to position myself for the future. Because in the next 5 years, it won't affect me. In the next 20 years, it'll change my business. Mm-hmm. So that's what I think.
Great. So you mentioned crypto. So we would like to ask you about what, in your opinion, what is the perspective for whole decentralized finance as a concept, or the reality that we are, starting to see, and what value, in your opinion, does it bring to the participants?
So, crypto's got a bad name, and it's got a bad name because it started with the notion of anonymity, and because it was anonymous, like cash, it gave rise to a lot of criminal activity and money laundering and some of the, bad things. So a lot of people think the only purpose crypto has is to, for criminals and money launderers. I don't think that is fair. That, there is some element that is being used that way. But more and more what I'm seeing, the anonymity aspect is changing. Today, if you go to open an account on Binance, which is the biggest crypto exchange in the world, you have to go through rigorous KYC. Now, it's all digital, so it's not difficult. But you have to show your face, you have to take a photograph, you have to do a selfie identification, you have to put proof of address, you have to put passport, driving license. You can't just simply open an account in any name you like. So I think that is changing. To your point about decentralized finance, Lucas, I think decentralized finance is a broad brush notion for an architecture and a protocol that is not owned by one entity. And I think there's a lot of power in that. So let's say, take a mutual fund for an example. Today, a mutual fund costs anything between 100 to 200 basis points in fees. Those fees are used to compensate the fund manager, to pay for the investment activity, to pay for the operations activity, to pay for reconciliation, accounting, bookkeeping, all the rest of it. Now, just think that what if you could completely automate accounting, bookkeeping, etc., and embed them in the blockchain as smart contracts? Mm-hmm. So no one can change it. There's no cost, no variable cost to this. Also think what if the investment activity could be done with artificial intelligence? Then a lot of the traditional investment costs disappear. And suddenly you could run a mutual fund at 15 basis points instead of 150 to 200 basis points. And so you could actually create an actively managed fund at cost that is less than Vanguard, which is passive fund. That is a massive, huge implication. And I'm just using one example of investment industry. There are examples in supply chain, there are examples in payments, there are examples in healthcare, there are examples in transportation that have similar impact. So I think decentralized finance done correctly has an opportunity to bring the cost structure down hugely by automating certain routine activities.
Mm-hmm. Yes, very interesting. So also in combination with wealth enablement, right. How would you combine, how do you think they complement each other, decentralization and wealth enablement?
See, think about it. Wealth enablement is empowering the individual investor to do things on their own.
Yeah.
It essentially means no one is in charge. Decentralized finance also means no one is in charge. And I think what will happen is these two things will converge, and decentralized finance will create more and more tools and things that a wealth enablement model could use. So each reinforces the other. The wealth enablement model creates a model where it encourages individual investors to do things on their own. The decentralized finance models creates the tools for people to do things on their own. So both supply and demand come together in this manner.
Yeah. So when we talk about decentralized finance and crypto, there is always a question about regulations. And I read your article about it recently. And you were saying, correct me if I'm wrong, that there is a need for some level of regulation to actually, to drive the adoption of, of crypto or decentralized finance in general. But in theory, it sounds like something that is some kind of a contradiction, because this is not regulated by design. So I'm really curious how do you think the regulation can help? Yeah. And in what aspect, and how actually this can drive adoption for, in this case, retail investors?
So that's an excellent question, Lucas. Let me explain, and it's going to be a slightly longish answer. But my simple view is that regulation is very good for the crypto industry. Why? Because it will encourage adoption. Because today, if you want to do something in crypto, you have to be a crypto wallet or a crypto exchange. If Barclays or JP Morgan or Citigroup want to get into crypto, they won't, because they don't know what the regulatory rules are. So none of the big boys are getting into crypto. The moment the rules become clear, the big entrants will come into crypto. And the moment they do, mass adoption will happen. So I think good regulation done the right way, can cause the crypto industry to explode. And when I say explode, not grow 2 or 3 times, but grow 100 times bigger than it is today. I think that is very good for the industry. Now, so if you agree with my thesis that regulation is good for the industry, then what is regulation? I think that is a very big question. What kind of regulation? Now, I think the core of the crypto industry, which is its ability to work in real time, to work 24 hours a day, never stop, real-time settlement, real-time trading, etc. These are phenomenally good things. They should never be changed. Where regulation can help. So firstly, at the point of entry, you must have KYC. There is no reason why anybody should be anonymous. Because that just gives rise to criminal activity.
Yeah.
Secondly, there must be controls around what kinds of tokens and coins you can issue. Today, anyone can issue anything. So that is where a lot of fraud has happened. So there must be rules around what you can issue. Just like you cannot just issue, go and do IPO. There are certain rules you have to follow. I think some of those kind of rules have to come in, that what kind of coins you can issue. Thirdly, there have to be controls around mis-selling. And the fact that customers can, anybody can come and say, I'll double your money. But, they can't double their money just like that. So there must be controls around bad selling and, vulnerable investors. Then there can be very simple controls around how do you actually service a customer, so around customer service. So if you go to Binance today, you cannot find a customer help desk number. With great difficulty, I found one. It was buried in some small page, 18 levels down, and then you find this is the support email you can write to. That is not good. Customer support must be front and center. There must be a number you can call. There must be ways to get in touch with these providers without having to resort to 100% bots or 100% kind of this thing. These are very simple regulations that can, but that is where it will give confidence. It will make it easy. If there's a problem, it will get sorted out. And there's a code of conduct that people can adopt. So that is how I think about regulation. My final point is that crypto is a global product. You may live in Poland, I may live in London, Margosha may live in Venezuela. But if we all buy Bitcoin, we are all holders of Bitcoin. It doesn't matter where we are. So there is limited value in one country putting regulation and the rest of the countries not doing anything. So there has to be some kind of cooperation between regulators to create a common code of regulation or whatever. Now you can say, how is that possible? That has never been done. It has been done. If you look at International Chamber of Commerce, ICC has issued a very rigid, not a very long document around how trade practices should work, around letters of credit, around documentary bills of exchange and stuff. And it is very well documented. It is very well understood. It is very well followed. There is, if you look at capital markets, swap transactions. So there is something called ISDA, International Swap Dealers Association. They have created a standard document. So whenever you and I enter into a derivative agreement, that is the standard document we will sign. So, international cooperation has produced results. And I think that is very important in crypto as well.
Mm-hmm. Yeah.
So you'll soon join the crypto reality, and it's really exciting time for the company, for your company, Bridgeweave, as you are nearing the launch for your new crypto product. So what do you foresee as upcoming challenges?
Good question. So our product is going to be a fantastic product, and it's not just because I say so. See, what is the problem in the crypto world today? I don't know what to buy. I don't know when to buy. Once I buy, I don't know when to sell. And because it is 24 hours, I worry that What if something happens when I'm sleeping? Or on the weekend? So how can I manage this? So it feels very intimidating. So what we have done is we have created a recommendation engine that basically tells you what you can buy. And it's based on AI. It's really a smart recommendation engine. Then we have said, and all our recommendations are very short recommendations, 2 hours, 3 hours, 4 hours, 5 hours. So the next thing we have done is, if I give you a 2-hour recommendation, you can't really, by the time you go and buy, the price has changed. So we have created some trading bots and created a transaction engine and attached that to the recommendation engine. So what does it give you? Basically, it tells you what you can do. And then if you say, yes, go, it will do it for you. It will go buy, it will go sell, it will set your stop loss, it will set your profit target, it will monitor constantly, and it will sell when it needs to sell. And then you can also say that once I have finished a 3-hour cycle, please keep going till I tell you to stop. Then it will keep going forever. So if you do nothing for 1 year, it will keep investing for 1 year, one after another. It's a phenomenally powerful concept. And we have backtested this over 10 months. We're now live testing it with real money. I'm one of the live testers. And it is doing really, really well. So I think we're coming up with a product that doesn't exist in the market today. It is a really first of a kind. Very easy to use. Now, it is not without challenges. Now, there is no point in product being very easy to use if no one knows about it. So communication and distribution are a challenge. We don't take any money from you in the sense that we charge a fees, of course, but the money sits in your exchange account. So if you have an account with Binance, all the money sits in Binance. All we need is an API key from you so that we can do trading on that account. Okay. A lot of people feel nervous about how to use an API key. Is it safe, etc. So, there is some point of friction at the point of entry. But once you're in, there is very little friction. So just educating people, getting them comfortable with it, and helping them make money, helping them understand. I think those are going to be the real challenges we will face. But they are exciting challenges because I really think that what we are doing is going to make it very easy for everyone, whether you're an existing crypto investor or not an existing crypto investor, for anyone to get in the market and be able to have a crypto portfolio.
Yeah, so I would like to go a little bit deeper because like when we were talking last year and currently, you are saying that you combine somehow the input from the user, from the person, the physical person, and combine this with this AI that you have, and this creates this powerful solution because it's a combination of you as a person plus AI that assists you as an investor. So how this play out with crypto actually? So how this helps in practice?
Yeah. So look, your investment appetite is always your investment appetite. I'm not the same level of risk taker as you are. You're not the same level of risk taker as Markusha. She's not the same risk taker as me. So everybody has a different view of the world.
I'm curious who the biggest risk taker is.
I don't know who the biggest risk taker is, but all of us have a different definition of risk and a different view of risk. It also depends how old you are. Sometimes when you're very young, then nothing matters. You go and do what you want. You make a mistake, never mind. You're 25 years old. When you get older, then you can tend to get a little more careful, or you might take completely different view that, look, I've made enough money. Now I can take as much risk as I like. So it's very individual. What we have done with crypto is given you the ability to dial up or dial down the risk as you like. So let me go into the details of the algorithms that we have. One algorithm that we have is called Hunter, Alpha Hunter. And what the objective of Alpha Hunter is to create low volatility alpha for you. Okay, so what it does, we cover 54 currencies. These are most liquid currencies in the market. We then look at the probability of each currency delivering a positive return in 2 hours, 3 hours, 4 hours, 5 hours, and 6 hours, 5 cycles. So 54 currencies, 5 cycles. So we do about 270 calculations every 5 minutes. Okay. When you come to invest, you decide how much you want to invest. You decide what your profit limit is. You decide what your stop loss is. And you decide whether you want to make it a continuous investment or just one-off. Okay? Continuous investment is good because it compounds your returns. So once you make all these decisions, we overlay this with the underlying thing that our AI has generated. We then figure out what is the best cycle for you to get in today. And the machine then decides how many currencies to buy. It could be 2, 4, or 6. It decides which cycle to take, 2 hours, 3 hours, 4 hours, 5 hours, 6 hours. So it has 15 choices. And it may say, okay, I will buy for Lucas 4 currencies for the next 3 hours. Okay. And then it will buy that. It will monitor your price limit, and etc. And do that for you. And it'll keep going. So this is one, if you're an adventurous investor, you want to make money rapidly, you want it to compound, this is a great way of doing it for you. You have to make very few decisions here. The second one is which we call accumulator. So hunter and accumulator. Accumulator is very different. And the accumulator is aimed for people who say, oh, I want to put some money in crypto, but what do I do? So I go open an account with Binance. I move $5,000 into it, and then I buy Bitcoin. And then what do I do? That is over in 10 minutes. After that, I have no idea what to do. So I say, okay, I'll hold on to Bitcoin, hoping it will go up and it will fluctuate. So what our algo does, it forecasts the price of Bitcoin in the next 6 hours. And it makes that prediction every 15 minutes. Okay. If the prediction is up, that price is going to go up, it does nothing. If the prediction is down, that price is going to go down, it switches your Bitcoin into US dollars. Okay? And if the price actually gone down, you have avoided the dip. At the end of 6 hours, it buys you back into Bitcoin. And if you buy back at a lower price, you end up with slightly more Bitcoin than you started. Okay, that's hence the name accumulator. Now, if you do every 6 hours, you'll get some cycles right, you'll get some cycles wrong, some will be up, so you'll do nothing. But over time, we have seen it accumulates very powerfully. So over a 10-month period, we found accumulation of 96%. So if you started on day 1 with 1 Bitcoin, you ended up with 1.96, almost 2 Bitcoin at the end of 10 months. That is a very safe, very powerful, do nothing, just sit back and do it. So we have catered for different kind of things. Then there are other algos we are coming up with. So what it does, it allows you to tailor your risk appetite. Now, it is a machine, and of course it works well, but it also underscores the importance of personal choice and personal decision. And this is what I mean by wealth enablement model. The model I'm promoting is a model where the individual can decide this is good for me, this is not good for me. Mm-hmm. It is not some advisor telling me that, if you go to an investment advisor or a robo-advisor, they have 5 risk categories. So basically they're saying that 1/5 of the world is same. How is that possible? And they will put you in the same portfolio, same everything, same all the time. Mm-hmm. I think that goes against choice. So, so I think the combination that in my mind that produces the magic is AI plus yourself. So you plus AI is what I have always called this. It is true for equities. It is true for crypto. It is true for, anything. You can have a beautiful car with all automated features and things like that, but if you don't know how to drive, you're not going to have a good experience. So a great experience is created by man and machine together, and in the right way.
Yeah.
Great. So before we finish, we would like to come back to this general topic about how the wealth management and retail investment in our case, how this will be evolving. And so I would like to just go deeper with one specific aspect, because this is a question: how much retail investment will be affecting the whole, or this always will be something marginal that is actually not shaping the whole investment space, because it will be still and always, occupied by traditional models, traditional, wealth management businesses, etc., etc.
Yeah, that's an excellent question. My view is that the retail investment is a very good thing for any country, and I'll tell you why. In a stock market, you have institutional investors like hedge funds and so on, and you have hedge funds and mutual funds, and you have retail investors. If you look at the volatility, not in terms of price, but in terms of flows, the institutional flows are much more volatile than retail flows. Because institutional investors have many choices. They can go into bonds, they can go into derivatives, they can go into commodities, they can go into FX. So they have many choices. Retail investors tend not to have that kind of choice. Okay, so in a volume volatility way, retail investment is a lot more stable, whereas institutional money is very volatile.
Mm-hmm.
If you're a national stock exchange,
Mm-hmm.
you want the right mix. You want some of the institutional money to come in because that moves the markets and is a sign of confidence and so on. But you want enough retail to give it stability. Otherwise, the market becomes like a crazy kind of thing. So I would argue that the more retail investment you have, the greater stability you have in the stock market in terms of people not, so it reduces the element of what is called hot money. India, for instance, is a very good example. For many years, the biggest part of Indian stock market was international funds coming to invest in Indian market. And when some other market became hot, they just moved all the money out. So the market used to go like that. In the pandemic, some almost 30 million new investors have come to Indian stock market. And the recent volatility, the market didn't change very much because a lot of stability is created by the retail investors. So I think it's, in a macroeconomic sense, it's a very, very important aspect. In a personal sense, I think it's also very important because it begins to create that connection between the individual and the markets. So everybody has a personal understanding and a personal view of it rather than simply reading about it on Sunday newspapers.
Yes, I think the second aspect that you mentioned, and also the product that you are promoting, I think you are democratizing the access to
exactly.
to wealth, and so this is very, very interesting.
Yeah.
So
and I think what I'm giving is I'm giving people a choice. I'm allowing people to get into asset classes they've never been able to. People who don't know how to invest in crypto, I think, never mind, you don't have to know how to do it. We will do it for you. You still have to make the decision. It is your investment. We're not advising you. We're not saying it is good for you. You have to decide what is good for you. But if you decide it is good for you, we will make it very easy for you to enter.
Mm-hmm. And also, it's also very interesting that the more people have access and have this opportunity to invest, the more stability we have. This is also very encouraging.
Yes, exactly right. Exactly.
Mm-hmm. So you've given us a wealth of insights. And before we finish, I just want to end with a question about how we should approach investing as retail investors. What piece of advice would you give someone at the beginning of their investing adventure?
I would say to a new investor, start as early as you can. Because what people don't realize, people look at returns. Okay. But if I invest over 2 years, then of course returns are most important. But if I invest over 20 years and I keep reinvesting my returns, the compounding of returns creates a bigger impact than the returns themselves. Mm-hmm. I would rather have a compounding investment over 40 years that compounds at 7% than an investment over 5 years that gives me 20%. I will make much more money that way. So if you're a young person, like both of you are, you're at an early stage of your career, you must invest and you must stay invested. All this in and out doesn't help. Okay, so my advice to a young investor would be, firstly, invest as early as you can, as much as you comfortably can, and then stay invested. So that is one. The second thing would be, there's so much intelligence and tools that are available to you. Use them. Make use of them. Don't depend on advisors. They don't know any better than you do. Don't depend on banks. Do it yourself. If you want to give your investments to be managed by somebody else, try and understand what they're doing, why they're doing. Ask them questions. They are obligated to answer. Okay. And the longer you have to invest, the better off you will be, because then you get the benefit of compounding. So I think investments are very, very important. I actually believe, just the way we teach English and arithmetic and geometry and algebra and history and geography, we must teach investing in schools. Why are we waiting till we are 18 years old? You must start when you're 8 years old.
Yeah.
Give them the basics. I don't want anybody growing up saying, oh, I don't have a head for numbers, I cannot invest. No, you can do mathematics. You can add and subtract and divide. You can do investing. That is all it takes.
Thank you. Thank you. Stay invested. This is definitely the piece of advice I'm going to take with myself. And I'm planned to use it literally and metaphorically too.
Thank you very much. Thank you.
Thank you. Thank you, Akshaya, for meeting, giving us your time. It's been a pleasure listening to you and finding out more about the product that you are promoting.
Great pleasure to speak to both of you again. And thank you so much for inviting me.
Thank you. Fingers crossed.
Thank you. Bye.